My name is Scott Watson-Brown. I lead our asset management practice here at PwC in Bermuda. I'm joined today, I think, working from your left to right, John Rathgeber, CEO at Watford Re, Aurora Swithenbank, Managing Director and Co-Head of Insurance Structured Finance at Goldman Sachs, and finally on the right, John Berger, Chairman, CEO and Chief Underwriting Officer at Third Point Re. So your panel today will address rebalancing risk and return across the whole balance sheet. So in an environment of depressed pricing, low interest rates, reinsurers seeking risk-adjusted returns are focusing on the agility and responsiveness of both their investment and underwriting strategies to changing market conditions and opportunities. But I guess we want to stand back a little bit and perhaps look at the model that in particular John and John are running up here, and take a look at this. You know, there's a few terms that are thrown around, hedge fund re. I've even heard this described as a radical new model. But if you look at it, the term hedge fund re seems to be attributed to any reinsurance relationship that involves a manager of alternative assets. John, perhaps we'll start on the Watford side there. I mean, give me some insight or a window into your role as CEO and how this is different from the past.
Okay. Well, it's certainly a different change for me, not so much because of the so-called hedge fund reinsurance model, but it's really more the outsourcing model that Watford Re has, where the underwriting is outsourced to Arch, and the investment management is outsourced to Highbridge Principal Strategies. So my role is really monitoring what's going on, understanding what's going on, keeping track of how these risks are balanced or not in balance, and acting as a liaison to regulators and rating agencies and the shareholders. So it's quite different kind of role. When I was running the U.S. reinsurance company, I was ultimately responsible for production of the business, for binding business, the underwriting decision making, and again, that's all been outsourced to Arch. So there, I just need to understand what it is that they're doing. So it really comes down to communicating that to the respective stakeholders. When I was at Arch Re, I would report directly to the holding company management. I didn't have a direct dialogue with shareholders. And I also had very little investment interaction. That was all handled by the holding company. So here it's different. I have a direct line communication with the shareholders. They're who I'm ultimately responsible to. And I'm a lot more involved on the investment side, which I have to say from my standpoint is very intellectually stimulating. I enjoy it.
Okay. I mean, and John Berger, I mean, from your perspective, there seems to be some misconceptions around hedge fund Res, and we've got hedge fund managers sitting on boards and how they influence, and they're in the operations, and perhaps even you're sitting there with a shell operation. But I mean, from a Third Point perspective.
Yeah, first of all, people say, oh, this is a new radical model. There's nothing new under the sun. Several other companies have really focused on the investment side, and they've outperformed the rest of the industry. Markel, for example, very high asset leverage, very talented investment people. Prim Watts at Fairfax does it. And the best example of all is, of course, Berkshire Hathaway, where you look at their annual report, and each year he dedicates one page to the float that the insurance operations generate. And last year, year-end, it was $77 billion. What does he do with that? He buys railroads, he buys catch-up companies, he does great preferred deals for Goldman Sachs. So this is really not a new model, right? So you can make money two ways: investment side, underwriting. And most companies, traditional companies, spend 90% of their time on the underwriting side and have a very conservative, low-risk investment side. That worked well until interest rates have plummeted, right? So now there's an advantage to being smarter and more aggressive on the investment side. So again, there's nothing new under the sun. If you look at our company, if you look at, it's very different than Watford Re, but basically a very similar game plan. You'd be hard-pressed to say this isn't a real reinsurance company. We take risk. Unfortunately, the first year we wrote crop insurance, so we proved we know how to lose money like the rest of the reinsurance market.
And Aurora, from your perspective, I mean, out there with Goldman's, as these deals come to market, et cetera, I mean, how's the model perceived by the market? How are investors taking this up?
I think a lot of the comments that my colleagues here said I'd echo, which is these companies exist on a spectrum. And I think there's this perception that traditional reinsurers have AA, 2-year weighted average life, bond portfolios. And many of them do, and before the crisis, that served them very well. And you saw investment performance in the P&C space, by and large, be quite good in the years when it wasn't so good for a lot of other sectors. And I think as the low interest rate environment has persisted post-crisis, as credit spreads on traditional corporate bonds have come in, it's been tough to make a buck on the left side of the balance sheet. And so increasingly, traditional reinsurance and insurance companies have been going into alternative assets. Now, in some cases, that means hedge funds. For others, it means private equity. For some, it means structured assets like CLOs. But I think there is a lot of focus on increasing, in an appropriate and risk-managed fashion, increasing investment returns. And that's something certainly that the markets are focused on when we look at valuations of companies.
Now, as these deals come to market, there's a few risks, both structurally and operationally, as they get up there. And we heard in the previous panel, Don Kramer just touched very briefly on tax, and I'm not a tax attorney, and I don't think any of us are heavy on the tax specialist side up here, but tax is certainly a risk, and we thought we'd just touch on it very briefly. I mean, it seems that tax is on every government's agenda these days, and as soon as you put a hedge fund title into an article or a headline, the flags go up, and people are structuring deals so they get favorable U.S. tax treatment. I mean, John, perhaps your thoughts on that?
So, again, to sort of restate what the issue is, if you are a U.S. investor in a hedge fund or really any alternative investment vehicle for that matter, as in the earlier panel was stated, you're going to be taxed on the dividends and interests on an ordinary income basis. If you invest, on the other hand, in an insurance or reinsurance company and own shares in that company, and the investment strategy is similar to the investment vehicle you otherwise would like to participate in, presumably you're going to be taxed at a capital gains rate. And that it doesn't matter whether you're onshore or offshore as far as that matters. It's the same logic. The question is it a legitimate insurance enterprise? And so you have Senator Wyden in particular, who's the head of the Senate Finance Committee, who's seems to believe that there were a number of companies that are just asset plays, they're not true underwriting vehicles, that there's abuse going on, and he's put a lot of pressure on the Treasury Department to come up with some sort of so-called bright line test that would allow people to differentiate very clearly what is a legitimate reinsurer and what is not. And I know the various trade associations have been in close dialogue with both the Finance Committee and the Treasury Department. They've shared a lot of data about onshore and offshore companies. And I think what's become very clear is it's just not easy to come up with a sensible bright line test, because all the ones that have been proposed so far, you would find very well-known, well-respected onshore companies would not pass those tests that have been proposed. So, in the end, it really, in my opinion, should be a facts and circumstances kind of matter, but it does seem as if Treasury is intent on coming up with a bright line test. You do have the recent election changes that's going to change the dynamic, so it's hard to say at this point, certainly as the chair of the Finance Committee is going to change, whether or not anything will happen or not. My feeling is if there is a bright line test, it'll probably be a liabilities to assets ratio test, and I certainly feel, at least in our case, it's nothing I'm losing sleep over in terms of being.
And John, from your perspective,
there are 5 hedge fund model companies, and you add up their surplus, and it's $5 or $6 billion, right? So at the end of the day, a really tiny portion of the market, which seems to be getting a lot of attention, and I think it's a commentary. And I'm American, so I can say this, commentary on our government, not seeing the forest for the trees. You're worried about increasing tax revenue, and so you're going after a $5 or $6 billion segment of the market. And this upsets my hedge fund and private equity friends, but if you're really serious about raising tax revenue, well, how about the carried interest that they get, right? Where most of their gains are capital, long-term capital gains versus ordinary income. That's a big number, right? How about General Electric, who makes $7 billion in profits a year in the United States and pays 0 in tax because they have really good tax attorneys? Why don't we go after that? So there's an agenda there. I think it's quite likely fueled by traditional companies that feel threatened by this model, would like to see less competition, which at the end of the day hurts the American consumer. So I think there's a lot going on beyond the scenes that we don't see. It looks to me like a lot of effort, a lot of misplaced effort.
Okay. Now, as you look at the challenges, I guess, in managing your business model and the strategy attached with it, I mean, we're seeing different structuring and operational options taken by groups where they're associated with the capital markets. You know, John, you said earlier on what the remodel, what you're outsourcing on both the investment side and the underwriting side, and then on third point where you've outsourced, you know, to a single hedge fund manager. But John, perhaps, you know, just this role in compared to past CEO roles and balancing that out, how do you find it?
Well, immediately before Third Point Re's Altera and before that Harbor Point, and we outsourced all our investment management. You know, at Harbor Point, we outsourced it to PIMCO, Deutsche Bank, BlackRock, and New England Asset Management. So many companies outsourced their investment management. We're different because we outsource it to one manager. So that for me has not been a change. So now you're managing the manager of your assets. Obviously, when we were Chubb Re, all our float went to Chubb, so it was a very similar situation where effectively Chubb was our asset manager. So I've never worked at a place, been CEO of an operation where we had an in-house investment manager investing all our money. So this is kind of status quo, business as usual for me.
Okay. And John, your experiences are similar?
Yeah, and actually, I mean, I think I pretty much answered that one. I actually wanted to follow up on some of John's earlier comments about misperceptions of hedge fund reinsurers,
Sure.
if I could just circle back to that. Because I think that really is like a key issue here. You know, on the one hand, some people seem to think there's no underwriting risk going on, it's just an asset play, and effectively it's a tax dodge. That's one end of the spectrum. At the other end, you have people that believe there's increased asset risk going on top of significant underwriting risk, and effectively you're burning both ends of the candle, and it's essentially a flawed model and doomed to fail. So you have kind of those two different extremes, and I think kind of wrapped in those perceptions, in many cases, a lot of people feel or seem to believe that the hedge fund owns the vehicle, manages the vehicle, decides not just investment policy, but underwriting policy, and that it's short-term money, that, you know, hedge funds are sort of known as being short-term opportunistic players, and capital comes in and out, and that really you're not dealing with permanent capital. And all I can say is that all of those beliefs are just not correct. You know, in our case, the hedge fund has no ownership stake, has no seats on the board, does not control the underwriting policy. The money is permanent capital. It's a Class 4 Bermuda domiciled vehicle, and if an investor wants to get out, they have to sell their shares, but they don't have a call on the money other than selling their shares to another party. So in our case, I mean, certainly we are taking significant underwriting risk, so it's not a tax dodge, but it's balanced, and it's a lesser amount of underwriting risk. There's much less cat risk, for instance, than you would have in a typical reinsurer. That's one aspect. Another aspect is the premium to surplus leverage is going to be much less than your typical reinsurer. So it's a rebalancing, it's a recalibration. It's true on the asset side, there's more risk. It's non-investment grade corporate credit, but there's capital there to back that risk. And in the end, it's all about matching capital to risk.
I think John made some great points there, and just to emphasize two of them. One is when we started Third Point Re, people said, well, Third Point put all the money into Third Point Re, and as John said, they put nothing in. Dan Loeb, the owner of Third Point, personally put money in, but the hedge fund put no money in. And then they said the other misconception is, well, when you want your money out, you have to ask them, and they could gate it. Our money's not in the hedge fund. Our money's in our account. It's a managed account, so that money's always available. So two really big misconceptions that are out there on this model. And then it's in a way, I can remember, I've been in business for 35 years. I can remember where like a company's risk manager was kind of like this guy getting ready to retire, right? He's like, well, let's call him risk manager. He buys insurance. Now you look at the risk management function in corporate America, but in our business, your enterprise can only take so much risk, right? You can take it on the underwriting side. You can take it on the investment side, but there's still only so much you can take, so much risk you can take. Now, how do you allocate that? And I think that's going to be on the underwriting side, the biggest change coming is enhancing that risk management function even further as companies are going to be forced to be more aggressive on the investment side.
Aurora, I mean, from your perspective, again, as you're seeing new entrants come into the market, are there unique considerations they have to work through? We just heard John talk about it, at Watford, the board composition, how management is there, the level of talent that's involved in the operation. But as these new entrants come in, how are you helping them?
It's interesting at the beginning, I think a lot of this was being driven by hedge funds looking to get into reinsurance. And actually, I think they sort of had the perception hedge funds are hard, reinsurance is easy. And as they started to get into it, they realized reinsurance is a...
I'm sorry. Their misconception was hedge funds are smart, reinsurers are dumb. So carry on. She's much more polite than the hedge fund people.
So I think they've gotten the joke that reinsurance is a lot harder than they thought it was. So actually the current generation of product and pipe is being much more driven by the reinsurance side and having a talented reinsurance group, thinking about a credible business model, thinking about premium sourcing, and then finding an asset management partner, or I'd say partners, because I think that's one evolution of where this is going, where it's not just a single partnership between a management team or a reinsurer and a single asset manager, but where you'd have multiple asset managers. And that, quite frankly, is not too dissimilar to the existing Bermuda Re formula, where you may have several different managers. Now, they're more traditional asset managers in the form of GSAM or BlackRock or PIMCO, but I think that's where this is headed. And so, again, I think the reinsurance mindset is driving a lot of the current crop of vehicles in pipeline, and that's leading to that lens being the lens through which risk management is designed.
John, you touched on an interesting point there, sort of an operational matter there about balancing between that underwriting book and the allocation to asset management. I mean, and you talked about how things perhaps are going to progress in future years, but I mean, maybe if we just focus on that, how do you deal internally with balancing between allocating capital to the asset side of the book or the underwriting book and just addressing that competition that exists?
I think one thing, in our model, you really have to understand why Third Point Re came into being. It came into being as a permanent capital vehicle for Third Point, the hedge fund. In 2008, in the financial crisis, hedge funds, most of them had near-death experiences. With the crash, their results were way down, and people were, I don't know if you remember, people were afraid. They were ready to just take their money and stick it in a mattress. So there were huge redemptions, and Third Point's assets under management went from roughly $6 billion to $1.3 billion, right? And what kept them alive was they had a London-listed vehicle that had about $600 or $700 million, and then management's carry in the fund was $600 or $700 million. All the other money left. And Dan Loeb, a lot of hedge funds gated the money and said, well, we can't give it back to you. Dan said, hey, these are our friends, investors. They want their money back. Give their money back, right? So now if you look at Third Point, the hedge fund, the London-listed vehicle is roughly $800 or $900 million. Management carry is a couple $2 billion. We're $1.7 billion in assets, so we're roughly a third of their total assets. right? So that if you get another financial crisis, they're alive, they're well. Because one thing, in that business, they may be down 20% one year. That usually means something big and bad happened in the marketplace. The next couple of years are usually terrific, so you have to stay at the table. So that was, and I'm showing my age, I'm rambling. What was the question?
Operationally, we're looking at how you're going to deal with that allocation
yes,
between.
So you have to understand that we came into being to provide permanent capital for a hedge fund. That is our reason for being. So Third Point will invest our money however they think appropriate. It's on a pari passu basis, exactly the way they have one fund, one portfolio, different funds. The allocation is purely mathematical based on size, right? So they're going to operate how they operate, and we will adjust the underwriting side for the risk they're taking. So as John said, they will write very little property cat. We will write very little property cat. It won't be, wow, we could write a lot of property cat now, Third Point hedge fund. You really dialed down the risk. No, right? But I think each company will have its own strategy. That is our strategy. That's the way we will operate.
And it seems something as simple as your liquidity of your investment portfolio was dealt with through a single managed account, essentially. So it's in your name. You can take it.
It's in our name. And 95% of what Third Point invests in are instruments that have marks.
Right.
Publicly traded instruments. If we need money, we can liquid.
Okay.
Yeah, we have great liquidity in our model.
And John, from a Watford standpoint, how do you go about oversight of both sides of the balance sheet?
Right. So, in our case, it's still early days. We've only had 2 full quarters of operation. The capital came in at the end of March. I would say so far the dialogue is quite collegial, cordial. It took close to a year and a half from the initial concept stage to actually launching Watford. So Arch and Highbridge were doing quite a bit of talking and thinking about how to structure this. So obviously they had a meeting of the minds along the way and have an understanding of what they're trying to accomplish. When I was brought into the picture, I obviously had to buy into the business plan to think it made sense. And obviously I do think that, otherwise I wouldn't have taken the job. I think in the long run, the key control is the board of directors. In our case, we have 7 directors. In addition to myself, there are 2 Arch directors, and then we have 4 independent directors. And I can tell you they're a very engaged group of people. They take their responsibilities very seriously. So, I'm pretty confident. Down the road, I'm sure there'll be animated discussions about strategy, but I think in the end, it'll be the board that keeps things on track, protects the shareholders.
Okay.
And these are independent companies which are intended to be permanent over time, and so inevitably as the market shifts, as market investment alternatives shift, as underwriting opportunities shift, I would expect these companies to tack over time to take advantage of those opportunities as they present themselves.
Okay. Just in looking at some of the stakeholder expectations when they're attached or associated with these models, I'll start with you, Aurora. What are you seeing as far as expectations? We've heard John just talk about the independent and the operating of the board, et cetera. Is it that institutional flavor that investors are looking for as they come seeking these opportunities for investment?
So I think when you've got a relationship like Watford does with Arch now has a whole nother set of investors. So Watford itself has to have an investor relations strategy, but many of those investors may also look to Arch as being indirect stakeholders. And so I think it just changes the dynamics of the investor relation discussion. And you've got to be very crisp in talking about how conflict of interests are managed and how the contractual relationships work to make sure that everybody feels like they're being treated fairly and have an attractive return potential.
And John Berger, from your perspective, your interactions with cedents, with brokers, rating agencies, investors, they're obviously familiar with the model when they're investing into it and through it, but those communications with them over time, have they a lot of explaining about what your strategy and model is, or?
Actually, we get a surprising surprisingly few number of questions on the investment strategy. And I think there are two things going on. One is, one of the great things that still exists in reinsurance is it's a pretty small business. Everybody knows each other, right? So we're reinsuring people we've known for years. We know the brokers. So there's that relationship. Your reputation, how you've conducted business, still really counts for a lot in our business. And thank God, because a lot of part of the financial world right now, you sit in front of a computer screen, you don't care who the counterparty is. Who the counterparty in our business is critical, not just what's the contract, but how those people acted in the past. And then, Best over time has done a remarkably good job regulating the industry. So you need a Best rating to get in. And once you have the size and the A- rating, people just slot you into their security list on where you fit in. So I think those combinations, or the combination of those two, we've had very good market acceptance. Now, are we acceptable to the company that has a long tail casualty that wants an A++ Best? No. But we'll get there.
And John, on Watford, I appreciate you've only been up and running for a couple of quarters, but again, any challenges dealing with some of those stakeholders?
Well, I think it's kind of the normal things that you'd expect. I mean, obviously, at least at a first glance, Watford might seem somewhat of a complicated structure, and you get natural questions about how do you navigate. Do I send the submission to a Watford address, or I send it to an Arch underwriter? Obviously, people want to understand the investment strategy in detail. It's really basic questions, and ones that people should be asking, and I'm happy to answer, and certainly haven't encountered any difficulties in answering any of those questions. I think from the rating agencies, AM Best in particular, key issues we had to navigate with them, and Aurora touched on this as well, is this whole issue of conflict of interest. How do you know that the interests are aligned? What structural mechanisms are in place to ensure that Arch isn't going to retain all the good business and dump all the bad business into Watford? I don't necessarily need to give into all those mechanisms here, but certainly those are the things that I do explain to people to give them comfort. I think in the end, it's our capital base, it's the rating that we have, and it's our association with Arch that gets people very comfortable with us.
So if we roll back to right at the start there, we're talking about this particular model and what it's trying to achieve and the focus on both sides of the balance sheet. I guess this model itself will impact the traditional reinsurers and what they're doing and looking and considering out there. We've got this soft pricing cycle, we've got the low interest rates. Your business models perhaps provide some solutions for producing ROE for investors. I guess, John, how do you see this business model impacting the traditional reinsurers? People looking over the fence and saying, perhaps I need to look at things a little differently on the asset side? I don't know.
Well, as I think the first panel accurately described, it's a very difficult market environment right now, despite the fact that they're very good published results. The kind of future profit outlook is pretty bleak. And at the same time, you have reduced demand. People are retaining more business. Despite the very substantial buybacks, there's excess capital. So it's hard for anybody to make a decent return right now. So I think, obviously everyone has to be thinking, what is, do they need to change the asset strategy? Do they need to change the business model? And there's not one answer for everybody. Everyone's going to have a different approach based on their cultures and the way what their existing shareholders, understand the model to be. I think you're definitely seeing a migration toward riskier assets. I think that's definitely going on, and that's really just gets down to the management philosophy, tolerance for risk. Obviously, you're subject to regulatory and rating agency constraints. It depends where you're domiciled, how much flexibility you have for that. That's the reason Berkshire Hathaway is domiciled in Nebraska, for instance, gives them a lot of flexibility. So I know there's a number of vehicles in the pipeline, Watford Re type vehicles, but it seems like the the time to bring these things up the gestation period is quite prolonged.
These are tough deals to get done.
Yeah, I mean, Aurora, again, you're seeing a lot of talk, a lot of activity, but actually converting them into live vehicles and getting to market is a bit of a challenge at the moment.
It is. I mean, there's been dozens of deals rumored in the insurance trade press, and obviously in the near term, we've only had Watford. I expect maybe 1 or 2 deals to get done before year end, and I'd expect maybe 5 to 7 next year. I think if you look at other perm cap spaces, like the BDC space or the REIT space, there's over 20 publicly traded BDCs. So we've tried to analogize, is that the right number, and think about corollaries with some perm cap vehicles. So I think there is space for a number of these vehicles, but they're tough to get done. And it's really tough putting together a really solid management team, a business plan that makes sense in terms of lines that can be sourced at attractive rates online, or that can be scaled, that don't cannibalize from the sponsor's existing book of business, finding an asset manager who the management team really likes, making sure that there's no correlation risk, that you're actually getting covariance, diversification. We spend a lot of time talking about things like tax, but I think where the real guts of these business plans are these very mundane, going through the numbers, and can you get the asset returns plus the underwriting returns to knit together, and not just knit together steady state, but also knit together through shocks. And can you convince the rating agencies that that business plan is going to be robust and pay claims in all possible circumstances? And that's just a tough process to go through.
John, the traditional insurance model and obviously coming over to this side of the fence, but your thoughts on that?
I think there's 3 big trends going on right now. One is, it's already been discussed, is the cat fund. Over time, property catastrophe has been the most profitable business to reinsurers, and the advent of the cat, the Nephillas, the Catcos, the Credit Suisses, I mean, they've changed the face of that market, right? So you're taking, reducing the margins in the most profitable part of the reinsurance industry. The second trend is our trend, where people are paying much more attention to the investment side. And one trend that has started and is going to really continue is just the distribution of risk. And this isn't my original thought. People have explained this to me. But if you just look now, you have an insured, you have an agent, you may have an agent, you may have a wholesaler, an insurance company, a reinsurance broker, a reinsurance company, and then third-party capital taking the risk. And there are people trying to figure out, I have the risk, there's a risk appetite, how do I circumvent all these people taking a bite out of the premium, keep more money, and these guys get the risk? That's going on. Agents now with the advent of big data and just the capabilities they have are getting better and better at knowing about their own business. So there's 3 trends. So if you're a traditional company and you're not paying attention to those, thinking, well, those are passing fads, they're going to go away. You may be right. If you're wrong, you're going to really be in trouble. So I think every company is paying attention to that. You're seeing many companies form their own cat funds. You're seeing many companies become more aggressive on the investment side and the distribution side. I'm not in that insurance link there, but people are spending a lot of time thinking about that.
I mean, we heard Aurora just mention a second ago that as these deals come to market, there's a lot of modeling, et cetera, that goes on that tries to look at the interplay between the underwriting risk, the portfolio risk that's there. I mean, I'll put it to both Johns here about how nimble are you in your ability to manage that balance sheet, responding to significant changes in risk pricing or other factors. Thoughts?
Well, I think, John and I used to work together, and I think pretty much I learned just about everything I know about reinsurance from John. So
that's not true, but it's a very appreciated comment.
And it all goes back to sort of Paul Ingrey and F&G Re and being opportunistic. So certainly on the underwriting side, that's always been a philosophy of going where the best returns are, the best opportunities. And I think it is a similar philosophy now on the investment side. And as long as you have a management shareholders that are willing to shift depending on conditions on one side or the other. I think obviously we're well positioned to do that. Right now it's advantageous to have more asset risk. Certainly if there's a major hardening in the market, there's absolutely nothing to stop us from ramping up the underwriting leverage, and obviously we'd have to scale back on the asset side. So that's, I think very much what we would do.
Right. John, you'd follow?
They're similar, though we're pretty much wed to, Third Point and what they do. And if you look at just the size of the markets, and B.J. Dowling puts out a great exhibit, and he basically, Berkshire Hathaway with that railroad they own, that railroad is the largest reinsurer in the world. It's big. It has more it's worth more than Swiss Re or Munich Re, right? And so the numbers are quite big. But if you look at our business, it's small, right? Apple's market cap, I think, is if you take Berkshire Hathaway and AIG out of the mix, I think Apple's market cap is bigger than the property casualty market cap. So kind of puts things in perspective. Meanwhile, the financial service market is hundreds of trillions of dollars. The hedge funds are in that market looking for opportunities all over the world in all different markets. And you got Goldman Sachs, the smartest people in the world, just looking for ways to make money where we do reinsurance, right? We're nimble. We like to take advantage of opportunities. It's a very small market compared to what a really good, a Warren Buffett can do in the world, or a really good hedge fund manager can do. So, they buy almost by definition, by just the composition of the market, can be much more nimble and opportunistic than we are, although we strive to do that also.
What I might do is just pause for a minute and just see if we've got any questions from the audience for our panelists. We have a microphone walking around if anyone feels.
Oh, Cliff. Cliff threatened to ask tough questions. Man of his word.
Since we're on here, since we're at a conference that's co-sponsored by a rating agency, let me put you on the spot and ask you about the rating agencies. So, John Berger, you've obviously been involved in a couple of different public-private, changing environments, and John at Watford also, kind of a pioneer in what you're doing. But how are the rating agencies? Are they overstepping their bounds in helping you or challenging you on your business plan?
I think AM Best is by far the most important rating agency for us. And I said before, over time, they have done a terrific job. They understand the model. I think we're beneficiaries of Greenlight. Greenlight started in 2008, and it took them a long time to get a rating out of Best, and Best is up to speed. So I think they're very conservative, hefty capital charges. I don't think S&P is as far as along. I think they will be. I think they're really good and they're smart. But this is a new, a new phenomena for them, and they will be good. But they have not. We don't have an S&P rating. We're not quite 3 years old. Eventually, we aspire to have one. I've heard that they're down on the hedge fund model, but I think as they understand it, it's they assess risk across all industries in the world, and I think they'll end up doing a good job on our stuff.
Yeah, I think they're asking all the right questions. They're asking all the appropriate questions. Maybe I don't always agree with the conclusions, but that's the right. That's their responsibility. I think with AM Best, we spent a very long time with them. They told us they put the largest team they'd ever assembled to evaluate a startup company to analyze us. So I know we were thoroughly scrubbed. We had to go back more than once with them, but it was all very reasonable, and it was again, they asked the right types of questions, and we had to do some rethinking of the structure in different aspects. But I think in the end, I think we do have a very viable model, and it's partly a result of the tough scrutiny that we went through. And I think in the long run, it's actually sort of a competitive advantage. If it were easy for anybody to just do this and set it up, and you'd have 25 or 30 of these vehicles overnight, and no one would be any better off. But to have a difficult process that you actually are able to navigate is actually a competitive advantage.
And two, over time, they've really you know, forget about the hedge fund model. What they've done to the industry has been dramatic. You know, 'cause, you know, like years ago, you could write 2.5, 3-to-1 premium. The industry is less than 1-to-1. The asset leverage could be 7, 8. The asset leverage is 2.5, 3 times. So they've really, you know, tightened the screws on the potential risk that companies can take.
Okay, well, I've always believed, especially you know, as running a company, I always wanted underwriters that didn't sleep well at night. You know, it's the people that don't worry about things that I don't trust. And so, I mean, I think I've always...
Hire Goldman Sachs.
So I worry about everything. And, you know, you have to walk in every day and you have to be paying attention to what's going on and you have to care about what's going on. And it just comes down to execution and, you know, not taking yourself, you know, knowing what you don't know. But it's nothing, you know, really profound. But, so yeah, I mean, I worry about the state of the market. Are the deals good deals? Are the investments sound investments? And all you can do is, you know, understand every transaction you enter into. And I think what does differentiate some of the succeeding companies over time than the ones that don't do so well is I do believe it's the ones that are more centralized in decision making, have senior management more focused on the details of what's going on, that have a lot of actuarial input into the process, in the long run do better. So,
yeah, I find myself paying, you know, I've always, you know, read papers and you know, good magazines, try to keep abreast of what's going on in the world, and I find myself thinking much more of the potential impact on financial markets because it's such an impact on the hedge fund who invests our money and what could happen there. And so I find myself worrying a lot more about, you know, is Israel going to really bomb Iran, and what does the world look like after that? Will the terrorists get a hold of a nuclear weapon and set it off in the Saudi peninsula and interrupt the, you know, is Ebola, you know, what happens if, you know, 20% of the world population die? I mean, all these really cheery thoughts. But those, you know, that could really have dramatic effects on the financial markets. I probably worry about that a lot more than I worry about, you know, the day-to-day risk, because I think our process is there. You know, we've done this before. We know how to do that. And so it's that, you know, kind of mega event that could just really, you know, upset like we lived through in 2008, you know, with the, you know, Lehman Brothers and AIG, and, you know, looked like every bank in the world was going out of business. You know, like, whoa, you know, looking over the edge again. What could get us to that? I think about.
With the ability to tailor your risks and so what with the SPIs and the alternative investment models, do you see the cap bond market diminishing where investors can now go out and tailor the risk to what they specifically want rather than a bundled package and possibly at a more economical vehicle?
I'm sorry, the question is, do we see the cat bond market diminishing?
Yeah, because of the ability to go out and get the same risk through other investment vehicles.
Yeah, I think, you know, the cat bond market has been remarkable. And I think what's really driving that now is the low interest rates. So you do now have, you know, pension, you know, trillions of dollars looking for yield. And I think as long as interest rates stay low, the cat bond market's going to be very vibrant. You know, what you can buy now, you know, why, you know, I talk to reinsurance brokers all the time, say, why every company, like in the Northeast, should be buying a big layer, should be buying a cat bond at the top of the program. You know, you can do it for, you know, 2 online, 2.8 right online. Why wouldn't you do that? And some companies are. So I think, again, as long as interest rates are low, that's going to be a pretty vibrant market.
And I think the cat bond investor targets a little bit different investor than the investors we're talking about here. Those are more fixed income investors. They're looking at constructing a portfolio of very specific building blocks of risk with a little bit of Japan typhoon, a little bit of northeast quake or southeast wind, whatever it is. And so they're looking very much for elemental risk and no investment risk, keeping the investment risk to an absolute minimum. So I think those funds are slightly different. There is inherently some overlap among some of the big funds or big pension funds who might also invest in something like a hedge fund tree, but I think there's room in the marketplace for both of those. And in fact, I think we're optimistic about the growth of the cat bond market, both in terms of natural perils, but also expanding into things like workers' comp or casualty lines.
With the announcements about the Ace BlackRock deal, would everybody want to comment on that? Is that if that's the flavor of the month, or is that something that every large commercial insurer will have of its own in the future, its own captive reinsurance arrangement?
You know, Ace is such a fabulous company. You know, as soon as they do something, everybody has to look and see if that's viable. You know, they buy so much reinsurance, and it's not clear if what people are telling me is that it's going to be truly a captive. It's going to take 20% of all the ceded business. You know, on one hand, you know, that's more benign to us because they wouldn't be out competing for business like we are, but that takes a big chunk of business out of the marketplace, and what it does to the reinsurance broker is big, right? So if they take 20% out, that's 20% of premium, 20% of reinsurance brokerage. Pretty dramatic change if that starts to happen frequently. But I think every company of reasonable size, and I know several that are, you know, once Ace does something, they have to. You know, it's almost a fiduciary responsibility. The board's going to go, hey, Ace did it. They're smart guys. Are we thinking about that? So everybody has to consider it. I don't think there'll be tens of those. I think there'll be a handful in the next, 12, 24 months.
Yeah, I definitely think it could be a trend. And it's certainly a different model than what we're trying to accomplish. I mean, the rationale is very different in our case. Arch really designed this to go after third-party reinsurance, not to be a captive of its own business.
The panel mentioned how the rating agencies appear to be getting more comfortable with a broader range of investments, but at the same time we have things like Solvency II, for example, in Europe, where there's rather penal capital charges for alternative investments. Is Bermuda a sort of a bright spot on the regulatory side in terms of its attitude towards investments?
Again, the BMA, again, over time has done a terrific job. We find them, their model is very comparable to what Best does, is very comparable to our internal model. So, we're finding them, very responsible to work with.
And certainly we see them achieving equivalency.
Yeah, and achieving equivalency. But the capital charges are hefty, that we get up because of the investment strategy.
What I might do is just, given we've got two CEOs of prominent Bermuda entities sitting up here, and we've given you a window into what's called a hedge fund re, and how these gentlemen respond to managing their balance sheet. Perhaps we just get some general market views from both of you. I mean, if we look back over the last 12 months, we can look at, just curious how you feel the industry has responded to this soft pricing that we're currently experiencing, and how have you managed through that process? I mean, John.
Well, I think it's certainly been a fascinating time period. I think the pace of change has been unprecedented. I think in contrast to past cycles, you definitely saw a lot more discipline by reinsurers for many years. And then in sort of in contrast to past cycles where you have a year-by-year gradual softening in terms and conditions, this time around it seemed like the pricing in terms and conditions just dropped off a cliff. So it's just a very interesting, different dynamic. And obviously we've talked at length about the low interest rate environment that we're all experiencing. So it's obviously a very challenging environment. And that's largely the reason, though, this vehicle was set up, is to try to respond to difficult market conditions, to try to find a way to find a niche to navigate through difficult times. And we believe, and again, it gets back to execution. You've got to deliver, you've got to execute in the strategy. But hopefully, we can get through this.
Yeah, you look at the business the last few years, there's, knock on wood, very few cats. Fortunately, the one here didn't, did some damage, but, the Bermuda construction is so good. Yeah, I think the damage was very manageable.
Except for the tent.
Except for the tent. Well, it's a tent.
We have a new one.
Come on, it's a tent. It's not a Bermuda house. I just think that the future is going to get tougher and tougher. Zero cat losses for several years, dropping a lot of income to the bottom line. Reserve redundancies are still, going with a vengeance. One day they run out. The industry's accident year combined ratio is well above 100 without those two in there. And so I think we're just, we're chugging along to some really tough times. How long it takes to get there, who knows? A common question people love to ask is how big a loss will change the market? I'm not sure there's one single loss that would change the market. Right? I think there's a lot of capital out there. There's a lot of capital waiting to come in. And I just look at this as the way the market is today, assume that this is what it's going to continue. It's going to slowly deteriorate for as far as the eye can see. Now, do you have a game plan that works in that environment?
And I think there are, not to add to the gloom, but there are some areas that concern us, like auto, where you look at the future of driverless cars and telematics and the potential for what has been a strong premium stream ultimately diminishing over time as those technologies improve. But I think there are some bright spots. Terrorism and flood were two big themes that we talked about last year in 2013. I think those continue. I think people are excited about cyber. There's very few places where companies are looking to shed more risk. There's a lot more talk about retaining risks in companies. And so cyber, I think, is who knows where that product goes, but I think it's at least a bright spot in terms of something where people want to engage and want to be creative around product solutions.
Yeah. So I guess to try and end on a bright spot then, you touched on a bit around, I guess, product innovation, but I mean, looking forward, John, just if we wrap things up and just perhaps get your perspectives on, just what you think success is going to look like out over the next 12, 24 months and what the future holds in the reinsurance market. John Berger, do you want to?
I think, it's hard for reinsurers to be innovators. We're at the tail end of the food chain in insurance, right? It goes from the insurer to an insurance company to us. I think the people like ACE, the Hiscoxes, they have, primary insurance underwriters that are out there thinking about, what kind of new products. So they're out there. There are a lot of new products coming out. Cyber is certainly a hot topic. I don't think anybody really knows what that is right now. It's being done in probably places people aren't aware of. But I'm confident that the brain power in a lot of the good primary companies are going to come up with new products. And then usually with new products, they're a little bit worried about keeping it all, so they come to the reinsurance market. That future look, John?
Well, I think largely it's kind of what we already talked about. I think it's navigating through difficult conditions, responding to changes in the environment. I think a lot of people have somehow seem to think like what we're doing is really innovative, and I just see it as blocking, tackling, responding in a sensible way to difficult market conditions. So. I kind of think when you kick the tires, look under the hood, it's not really the Batmobile that we're driving. It's more of a Honda Accord, and so it's maybe not as innovative as people are trying to make it out to be.
Okay. Well, just before we break, I'll just open it up one last time if there's any final questions for the panelists. And if everybody's fairly comfortable with that, ladies and gentlemen, if I could ask for a round of applause to thank our panelists today. Thanks, John.